Hello, dividend growth stock investors. Happy Friday to you. You got Colby here, the DGI Crab, and this is, just so you know, my favorite video of the week to make. Here we are about a quarter after 3 o'clock U.S. Central. The markets are closed for the weekend, and this is where I go over each of the stocks in the four tiers, tier 1 through 4, broken down by age, and discuss where the value is if you are following a similar strategy as I do using my spreadsheet here and my dividend growth stock model. Before I jump into the tiers and start explaining all of this stuff and getting the discussion going, I will preface it all by saying I'm not a licensed professional financial advisor, and the opinions expressed in this video are just one Crab's opinion, and you should always do your own due diligence before investing in any stock or any type of security. And I want to make sure I have enough time here at the end to go over just essentially like what my basic strategy is and explain exactly what I'm doing and how I'm following along with the plan, what I'm doing in my age range, which is tier 2, age 31 to 41, what I would be doing if I was 30 or younger, and what I would be doing if I was 42 to 53 or 54 plus. Honestly, it doesn't matter how much or how little money that I had invested in the market or what I owned at that point in time. I think that this particular strategy that's very aged and time horizon based is just, I think, a tried and true method for dividend growth stock investing. You always need to keep in focus your age and your time horizon when you are picking your dividend growth stocks, because while picking quality stocks is important, like the 60 I've selected here on this channel, knowing which ones are right for you for your age and time horizon, I believe, is equally as important as picking quality. All right, so we're going to jump into tier 1 here real quick. Same story as it's been for a while now, guys. Nike will continue to be the #1 most undervalued stock in this tier while they remain down here in the mid to low 70s. Nike has a ways to recover before they get back into the 4-year average yield range of 1.03%. The longer they stay down here in the mid to low 70s, the more gradually this 4-year average yield will start to increase. I do religiously update this every Friday, even if most of the time we're only going like 1 basis point at a time, but I will continue to do that to make sure we've got the most up-to-date and accurate information that I can provide. You just got to look at one of these things. The 4-year average yield is 1.03%. It yields 2.04 right now. Feels like Nike has yielded about 2% for an eternity if you follow the stock market every day. But in reality, it's just been for a few weeks. And Nike's a globally recognized logo and company. Their dividend is, by all metrics and accounts, very safe from a cut. So this is, in my opinion, a wonderful time to just build up a nice large position in Nike before they start buying back their own shares and pushing the price of the stock back up to something that resembles more normal for them and for their standards. And if you look here, we had some better deals in the last couple of weeks. Remember when UNH was just knocking on the door of being in this green category? By the way, for your first time here, green is 30% undervalued or better. Yellow is 20 to 29%, and red is below 20% undervalued all the way down to overvalued. But yeah, remember when UNH just a couple of short weeks ago was about $100 or maybe $80 cheaper per share, and they had a great earnings report, and now they have shot way up to $565. Could have been adding those a couple of weeks ago. I did point out that I thought that might have been a good idea to throw a little bit of cash at that. But right now, looks like it's just not a fantastic deal. It's not a disaster, but I would be holding off if I were 30 or younger, and I would be focusing in on Nike. I like Nordson a couple of weeks ago when it was down in the 220s, but now at 236, well, it's not a terrible buy. It's just probably one that I'd wait on, especially when I had ridiculous value here in Nike to focus in on. Tier 2, your 31 to 41-year-old investors. We still have the same 4 stocks as last week here in the green, Hershey and Starbucks. remain our top two. But Starbucks, man, here today on Friday really had a nice end of the week here. They were the number one most undervalued stock in this group last week. They were 50% undervalued at that point with the yield above 3%. And now they've gone on a bit of a rally. But I still like them where they're at right now. And I will just let you know that I have added to Hershey, Starbucks, Target, and McCormick this week. I absolutely did, as well as Nike. So I'm going to break that down for you here in a bit. Next Era Energy is close, but not quite. I'd like to see them fall just a little bit more, but but all four of these, or all four in the green here, I've got no complaints about adding them, and I've been adding them to my own portfolio this week. And American States Water, a couple of weeks ago, I was adding to them, but now they've ticked up a bit in value. Still not a terrible value. 21% undervaluation there by my metric, but there's better deals here on the spreadsheet for my age tier, so I've got no problem kind of sitting back and waiting. McDonald's, I still want that to be in the yellow. I want that undervaluation to hit 20% before I start adding back into that. But McDonald's, I feel like they might be about ready to go on a run. We'll see if I'm right. Maybe I'm right, maybe I'm wrong, who knows. But just feels like McDonald's isn't going to stay down here on the on the lower end of the spectrum by their standards for too much longer. We'll see. Tier 3, age 42 to 53-year-old investors. So we've got technically just one stock here in the green. Hormel's still sitting here at the top position, but Hormel did rally in price a little bit this week. They were threatening to drop below 30 for the last couple of weeks, and they've managed to climb back up to 31.79. Still an undervalued stock, in my opinion, and I think it's a fine stock to add for this age range, getting a nice 3.55% yield at that particular price. And then just barely, just 29.96, 29.84 respectively for Medtronic and Archer Daniels Midland. I'm just going to give them the benefit of the doubt here and say those two still look like solid value adds at this point in time. You always want to get your dividend income at the most attractive price that you can. But Medtronic and Archer Daniels Midland still looking good to me here. American Tower continuing to rally a bit. The REIT sector is looking strong on the guesstimation that the Fed is about to start lowering the interest rates. I'm in the minority opinion on this. Now, I'm not an expert on the Fed, but I'm of the opinion that September is going to roll around and the Fed is going to announce no rate cuts. Sorry, if I'm right, you heard it here first, because everybody is assuming that there's going to be a rate cut, and I am holding on to some cash right now because I have a lot of REIT exposure in my Roth IRA, and I've been buying a lot of REITs earlier in the year, like American Tower, like Realty Income, to that Roth, so I can get the dividends tax-free later on in life. And you know what? I'm just thinking that the Fed is just not going to cut rates in September. I don't think they're going to raise them either, but I think they keep them right where they're at. And when that happens, if that happens, the REIT market is likely to absolutely crash. And I'm going to swoop in with some cash I have on the sidelines and buy. If I'm wrong, oh well, I'll use that cash on something else that's undervalued at the time. There's always going to be something. But American Tower, it's rallying a bit right now, and as well as all the other REITs, more or less. Johnson & Johnson and Pepsi, still pretty solid buys here. These are both stocks that are on my top 10 favorite stocks. I'd like them to get in that 20% yellow range before I would want to start tacking on to my position there, but they're such quality companies. I don't even wait for them to hit the 30%. If I can get them at 20% off, that's good enough for me. And then we're just still kind of waiting on some of these other ones. No need to jump in and buy them at fair price or overpriced. I'd rather just add to ETFs, and we're going to talk about that here in a bit. But if I'm adding single stocks, I'm just not going to add them unless they look to be very much on sale. And Hormel looks like it's on sale. While I like the Procter and Gamble company more, they're in my top 10 favorite stocks list. I'm not going to add them when their yield is just right at the 4-year average. That's fair price. I'm not looking to add individual companies at fair price. I want a deal. I'll just buy ETFs if I can't find a deal. Speaking of not being able to find a deal, our tier 4, 54 and above investors. So listen, second week in a row, nothing even in the yellow category at 20% undervaluation. And what do you do here? You just this is a hard category because in order to get into my top 60, you had to have a solid history of dividend increases or at the very least lack of cuts in this particular group, at a very above average starting yield, and at least a respectable sized market cap for your industry. And there's just not very many stocks that fit the bill there. I recently did this week my series on the on the bubble stocks for each of the 4 tiers. There were a lot of REITs for this tier 4 group, but honestly, I just got down to these 10, felt good about them, and in this particular environment right now, there's just not a lot of value with these high yielders. Realty Income in the low $50 range was pretty solid, but again, it's a REIT. It's recovering based on the thought that the Fed's going to cut interest rates. And if I'm, especially when I'm 54 and up and I have less time to make quote unquote mistakes on this, less time to reach, instead of waiting for value, I'm not going to do it with single stocks. I'm really not. Go with ETFs at that point in time for that level of stability. So last couple of minutes here of the video, I just want to talk about something I haven't done here on this Friday video, and I'm going to do this moving forward. So I am personally a proponent of whenever you invest, whether it's once a week, once every 2 weeks, once a month, whatever your pattern is, that you put half of that into ETFs and then half of it into very underpriced single stocks, and I would say at least half into ETFs, because again, if I cannot find a deal on single stocks that makes sense, I'm not going to invest less. I'm still going to invest the same amount. I'm just going to put more into the ETF allocation. So here is what my strategy would look like, if again, depending on what my age is and what tiers would be. Again, this is not financial advice. This is just what I would do, following my plan, my strategy. If you want to follow along with this, you're more than welcome to, but I'm not telling you to officially. So for the tier 1, so my breakdown would be 25% S&P 500, 15% small cap, 5% dividend growth, 5% international, and I'm not going to reach up into any of the other tiers unless there's at least a 50% undervaluation, which right now there's not. So for my stock allocation, I'd put the whole 50% into Nike. I just think it's that good of a deal. You can yell at me in the comments below if you don't like Nike, but I like it at these prices, and that's where I'd put everything if I were 30 or under. Tier 2, dividend growth 25%, S&P 500 15, small cap 5, international 5. And this is exactly what I did with my allocations. I went 15% Hershey, 15 Starbucks. I dipped down to tier 1 and put 10% into Nike, and then I just threw a little $5 each at Target and McCormick, the remainder of the ones in the green. When I hit tier 3, it'll be VYM, SCHD, 20% each, DHS and VYMI at 5% each. This is just more focused on dividend yield. And I'd go 25% Hormel, 10 and 10 into Archer Daniels Midland Medtronic, and I'd even dip down here and maybe put 5% into Nike, 2% yield, good growth. And then tier 4, I break this down into 8 different ETFs where I'm getting yielding stocks, preferred shares, bonds, MLPs, some covered call ETFs, and still my international. This, if I was 54 and up, I wouldn't even mess around with it this week. I'd just take that remaining 50% and I'd just round up, and I'd put most of that into DHS, and then an extra 10% into the high yield bonds because those look like they're a deal right now. All right, until next time, investors.